Darrell Jones, Director of Research at Hedgeye. Welcome to the Macro Show for September 5th. Hope everybody had a long weekend. We, of course, encountered some long weekend traffic coming in today, but we are here, maybe go overtime a little bit.
It should have been more proactively prepared.
Yeah, these, roads are a lot of times the worst traffic in the country. Probably LA is a little worse, but it's not good around here. Everybody moved out, right?
55 minutes it took. Usually, like if it
20 minutes.
less than that.
Yeah.
It is what it is. It's traffic, and thank you very much. Welcome back from your Labor Day weekend. It is time for labor. Top three things this morning. Europe's going to hit on that. Oil and then interest rates. First on Europe. I mean, we're talking. Obviously it's a recession in Europe right now, and it's only obvious to those of you that are subscribed to this, as opposed to the old wall media and all that pablum. This is getting worse across the region. You're seeing like these business confidence or business activity PMIs at a 30-month low. The UK, of course, is not Europe, but those numbers were tremendous when you look at the services sector in the UK. And all I can say about all of it in Europe is that it's some place oscillating between quad 4 recession and quad 3 stagflation. So if you ask the European consumer, you ask the British consumer, you ask the Irish consumer, nobody really cares about what we think up there. But hey, if you ask us, we'll tell you. It's stagflation. The cost of living remains sticky and high, and now you're starting to see the commensurate slowdown in the corporate sector. You pick up its pace on the downside as it does during a recession. So when you really think about positioning in Europe, number one, we've nailed it, in particular on the currency trade from last week. But that's not just a trade, that's a trend. You can see that this morning in the early look where I go through why the dollar is so strong this morning. It's up again against both the euro and the pound on this data, by the way, which is a great position for us. And consensus completely got it wrong. So when you really think about like what do they really know other than their charts, absolutely nothing when it came to the dollar and translating that to the weakness in Europe relative to their views on Fed policy. So that's where we're at on that. If you look at the European short via the France short, for example, you can see that market stopped going up in April. Okay, so it doesn't have Nvidia, it doesn't have all the FOMO and the MOAB that the U.S. has, which is uniquely American, of course. It's got what it's got, which is the European equity and currency markets have figured out that they indeed have a problem. So we'll remain short of Europe and China. We're going to reiterate that on Thursday for Macro Pro subscribers, and obviously all of you institutional subscribers. We're going to have that on our Q3 macro mid-quarter update call that we're going to do on Thursday with a lot of new content refresh. Point number two, what a move for oil. So the way that Wall Street works is pretty straightforward. What they want and they need is more capital. So in other words, they saw some weakening jobs data last week. I thought that the jobs number, I didn't think it's not a qualitative thought. It was fine. It wasn't like some kind of a bomb on non-farm payrolls. In fact, it beat their consensus. But what Wall Street really wants and needs is A, the Fed to stop raising rates, and B, to cut rates. Okay, so they've already priced in on that jobs number, and I think it's a very much illustrative of these 2 points go together, really, oil and interest rates this morning, of the problem that they really have now, which is right there, right on the screws. You had oil up 7.7% last week. I mean, that's up 27% since June. It's good for us. We're not just long oil. We're not just long gasoline, UGA. We're not just long energy stocks across the board and uranium. We're very much understanding that this is going to inflate the CPI report, which is going to come out next week. So again, this is important, and the bond market figured it out. So let's just get to interest rates. Very good example of what not to do or what to do, depending on what side of Hedgeye Nation you're on. Of course, all of you are paying for it, so I assume that you're on the right side. But you could have looked at that non-farm payroll number and said, wow, this is it. This is what we really wanted. We wanted a deteriorating labor market so we can get Fed rate cuts or at least no hike in September. And they priced down the rate hike down to a 7% chance. Think about that. And the 10-year yield went to 4.05 within minutes of the jobs release. I was tweeting about it. Okay? Within minutes, it was at 4.05. Now what is it at? It's at 4.21, 4.22. Okay, we're talking about a material move to the upside in both the interest rate or bond market and in the currency market. The dollar was down on the news as well. So they're trying. Oh, damn it, are they trying? This is part of end time. The elites need that, right? They need that. They need to have the Federal Reserve to create what? Without them saying so, more inflation of assets, which includes, of course, oil and the things that people have to incur as cost of living. So it's a real tough spot now for those that are cheering on the latest stock market rally, which is really a month-end markup. Let's just be clear. I mean, they took Apple from bearish trend to vertical on fumes, even for Apple, and no matter where you go, there it is. It was a big 3-4 day rally into month end, and that's all you got. But the economy continues to slow into quad 3 stagflation. End of period time. End times. Got I cited it last week. I didn't stay with this book. This is a phenomenal book. Okay, this really puts what's going on in context here for the many of the people, and it's borderline disgusting to hear people just talk about, okay, well, rich people are fine. Like, this is ridiculous at this point. But I mean, the guy makes a very good point here, Jonesy. He actually says that the America that you have today is similar to the 1950s, in that between 1820 and 1860, when you look at relative wages, like the money that the people get relative to the 10%ers, us, to be clear, we're the 10%ers. Okay? I'm not saying I'm not. I'm just saying that I understand that 90% of the population still matters. Okay? So in the 1920s and 60s, the relative wage, or the share of economic output paid to each worker, declined by 50%. 50. Okay? So we're in the same kind of 5-decade since, it's been a long time since we've had the 1970s type setting. But it's what people are struggling with every day. It's why consumer confidence continues to slow. It's why when people are just generally discussing with the data. Oh yeah. That was muted, but yeah, it'd be interesting to overlay that with meal cycles for this real correlation. Yeah, what he does here, it has demographic components to what he's saying. But what he's really doing is digging deeper into the nature of each economic collapse. In particular, the Chinese one, the European ones, from if you actually dig into France in the 13th century, who's done that? I mean, it's like really, really good work, really good book. If you haven't read it, it's okay. I already have. You can listen to it, read it, but it's being incorporated into a process in as much as volatility, shorter-term data, and that's the key. It's so much work. It's so much easier just to say, stocks go up. Right? Think about that. It's not just an ideology or a compensation structure for many, being a permabull, which has got dire consequences over a long-term period, or for your full investing cycle life, which many of you work so hard for your capital. When you think about it, it's just a lot easier. I mean, imagine having to do all the work across durations, trades, trends, and long-term tails. Long-term tails, but then contextualizing that tail and understanding that demographic reality within the context of like short-dated vol option trading. Tough. Not tough for me, tough for them, so they'd just rather say stock go up, okay? Many of these people are still in an epic drawdown, by the way. Imagine you're still long Bitcoin. Tough week. Tough morning, really. There's no institutional manipulation there, like you have obviously into the month end for the SPYs. 43.35. Not much movement here, even though volatility got smushed on super short-term vol at the low end there, Jonesy. So you got 45.41. That's an interesting setup, okay? Obviously, where we have now almost 5-1 on the downside. So on a long-short basis, I have 0 longs. I think that's pretty clear for those of you that saw me selling into strength last week. Those are all gone, all the longs. I have 9 shorts. This is, of course, not a portfolio, but it's a good proxy, and it's a great coaching tool, okay? So in my long-short book, I'm at minus 14.5%. Again, I had a very good week in a lot of different things, and in particular my longs. So you can see that long-only book. Jamie Bruno's like, well, people don't all want to hear that you're hitting all-time highs. Well, what do you want me to talk about? What do you want? I mean, last week was one of the best weeks I've had in years. I mean, I don't know what, it should be yours too. I mean, we had a lot of things that were going up a lot. A lot of you are long, obviously, things like FDRXX or T-bill or whatever, where you get payday. There's a lot of good that's going on in terms of our process on the long side, and I'm not going to stop talking about it, okay? What we really got to do is get those of you that didn't do that in a better position where you're executing so that your longs, again, I think I have 23 or something like that, long positions are closer to mine and you're working the sizing, we're working on different tools and products here at Hedgeye at different price points for you to get that a little closer to real time. Of course, we understand that Macro Pro is an expensive product, but again, I think it pays for itself, or at least that's what the feedback's been. So, no matter where you go, here we are. Those are the position changes that I've made, and those are the results. Okay, what else we got going on for you this morning? The VIX 1309, again, smushed it right into the close. Top end of the range comes down inside of 18, which is new. That's why the top end of this range went up, and this is kind of unchanged, sort of unchanged, so to speak. What else we got going on? VIXIN, NASVOL, again, I think it's the third day in a row where NASDAQ volatility is, again, testing this area where it's failed to hold like a ball underwater. So again, below 18 and a half, it's rare that it stays there, and I don't think that it's going to, but we'll have to see about that. We obviously have an open mind. I do not have a position, obviously, in the NASDAQ or in the XLK itself. That came off ETF Pro, or should when they give the monthly update this morning, because it's back to the bullish trend. I mean, if something goes for a day in there and it goes back to bullish trend, like, what do I care? Get out of here, right? Just get out of here. Get out of my life. You don't have to be here. Just put it in a new position. Short Austria. Why not? Why do you have, some of you have such, I know why, but the fact of the matter is you shouldn't care. You shouldn't. You just shouldn't. Shouldn't care whether you're short QQQ or EWO, which is Austria. It's just inventory. Just units of risk that you're using to hedge your book, right? That's it. Doesn't have to be what Wall Street needs it to be, bulls versus bears. Just what are your positions? Be dispassionate, apolitical certainly, on what those positions are. Looking at Friday, 5-11 sectors are actually down today. Volume is down the world. I mean, so again, you had up day, but you had big open on the upside, and then it failed throughout the day and came on. No real volume. Move index all the way down to 103. Getting some questions on that. That's also because, Treasury bond vol can go away in a couple big different ways, and this is one. This is where interest rates aren't really going to go much lower than where they were at the low of the range, because that's what the range implies, right? You go from 405 to 421. Clearly, that was a pretty damn good setup for you to, more so what you didn't. Like, I heard some people running around saying it's a great day to buy duration on the open on Friday. Absolutely not. And to anybody in the hockey rink, which I was there on Friday in Massachusetts, that would listen, I'd say, are you out of your mind? Of course, nobody in the hockey rink is talking about trading rates or currency. But the fact of the matter is that that's how I traded it. I hope you did too. So again, what you're seeing is some volatility coming out because interest rates really won't go down or break down through trade or trend levels that matter. So that's interesting. So it doesn't mean I'm going to be buying duration. That's for damn sure. I like my shorter term duration position, which is of course the FDRXX. High yield, right at the spot to be adding to short. So hopefully you did that, and then understanding that we'll see where that goes today. Of course, Asia last night, Japan up, India up, good. China down, good. So those are our positions, and we're sticking with them. Hong Kong EWH was down, or the Hang Seng was down 2.1% for short. EWH were long INDA, INDY. We added to those. Those were up in the re-rank for the asset allocation. Another good decision that we made in terms of core asset allocations. And Japan has obviously been great in terms of doing what it should have done. And again, in the middle of the month, people are talking a lot about how this rally came back. Well, what they really got back was the things that they were all long together that were going down. Now, what we did was, I told you to buy energy and buy Japan and India. Now, again, energy and Japan were bigger, and then India became bigger. So that's what we're going to do. What we do. That's it. We're going to execute on our game. I've been saying this to my kids all weekend, Callie and Jack, because they're back at it in hockey, a 13-year-old, a 15-year-old. Like, don't worry about what these other kids are doing and their parents are telling them to do. We have a plan. We're going to do what we think we should do. We've been preparing all summer. Don't worry what they're doing. Shit. Yeah. So when you really think about what they're forced to do in markets, more than 90, much larger percentage of these people, A, have either never risk managed a cycle correctly, or B, actually been in the game for a full investing cycle. So don't worry. Don't worry. You're at the country club on Labor Day. On the putting green, you got some guy, nothing like a lawyer or a dentist telling you what to do. That's tough. I want the lawyer the lawyer, and I want the dentist to clean these chucks. But I don't want them to tell me anything about the full investing cycle. Okay? Keep going. What else? We got some Europe. it's gonna be a good day on the short side. Already talked about that. Already talked about oil, gold. I'm oscillating in there, just trying to help more people all the time. People, oh, can you show me the GLD risk range? Can you show me spot? Can you show me COMEX? And today it's spot. The other day was GLD and just COMEX. Please don't go on so like that. You can generally know, what you should be doing there. You can do it. I think you can at least. I can. I'm adept at doing that. It's not a high level play, by the way. It's just what it is. Gold volatility 11.28 it is. Silver down here, I'll be buying some of that today. That moves back into the asset allocation on red as it should. Already talked about bond yields, again up a lot since where that was. I already mentioned that. Bitcoin low into the range, 24,805. Big lower high.
That was fascinating to me because you had what people perceived was huge, not massive, flat, but huge positive events, favorable rules by Rick, favorable lawsuit against by Grayscale. Rick, ETS Rick, that was the top, right?
Lower high.
You chase that, you down on the ETS of 15%.
I mean, if you were buying whatever Rug Paul's latest chart was saying in July, you're already down 20+% Ethereum or whatever. The fact of the matter is that that's a bear market. Everyone can see it in crypto. People on Wall Street are generally not compensated by crypto. We got a whole other animal here with mother of all bubbles, the year to date, et cetera, but it's the same thing. It's the same thing, which is speculative assets without institutional support or month-end markup look a lot like Bitcoin, and or worse if it's some other shit. All right, let's take a question.
Yep.
Did I mention in currencies, by the way? It's been a while, but you have a trifecta this morning, and what I mean by that is you have all three majors, at least according to me. That's why I publish them. Canadian dollar is not one of the majors, although I do publish everything every day on the signal good there, which is surprising given oil's move. But again, I like surprises. I don't need surprises. I don't have to have. But the big three, yen, euro, and British pound, are all signaling bearish trade and trend versus the dollar. So for those of you that stayed with the process instead of people's white papers on the demise of the dollar, well done.
Okay, big news today. Questions about this? But Goldman reducing their recession forecast in the next 12 months, 15%, 35% in March, 15% now. Labor market strong, inflation is decelerating. All is good. Thoughts on that?
Yeah, on the other side, Goldman's prop desk is trading recessionary odds. Yeah, so recessionary odds for a rate cut in May went to like 75%. And no cut in September. So of course, Goldman's research is different than this is. But that notwithstanding, a couple points. One, I'd say the odds of recession in the third quarter being reported are going towards almost zero. So they're wrong on that. Q3, we'll walk through this on Thursday. Again, major league government spending that has not been curtailed. Again, there's some dynamics inside of the numbers that keep GDP positive. Okay, could be positive 2 to 3+% in the third quarter on a headline basis, not year over year. But it's the fourth quarter and then the first quarter that again that takes the probability up that you have recession in the first and the fourth quarter. That's where we have it tracking.
Yeah.
So again, when you do it the way that Jonesy does it, do it the way that Drago and I and Drake and the whole team, Steiner obviously, Richie, Rooster, Richie and Rooster's the same person. Don't want to double count. Tex, Burnett, they're all there. Markets and economic probabilities are all about bean counting, the stochastic nature of these things. It's an easy process. Therefore, as the data changes, we don't sit there and slap up 15% probability on a recession when the recessionary odds are dropping in the third quarter and ripping in the fourth quarter into the first. So that's a much better way, obviously. Again, if you think about it like traffic today for me, Goldman would say, well, my optimal model says the probability of keep getting there in 43 minutes is X. When the reality was that the thing changed as I was in the car materially. That is, again, updating for real-time information. I was accelerating as the car is. So again, we're doing it the way everything else in your life goes. They're doing it bullshit, right? That's what you've always believed. You never quite had somebody giving you specifics on how much bullshit it is.
Well, the one thing for us, how do you say his name?
Jan Hutchins.
Jan Hutchins.
I always remind people, you know, in the third quarter of 2007, GDP had a 2 handle in front of it, just like it does now. Might even have a 3 in the third quarter. The third quarter, by the way, ends in, you know, like the market's really trading stagflation. So again, I know it's easier, we talk about easier, right? 50-day moving monthly, I'm gonna chase it in the middle of July. Terrible. Okay? Quad. I like it when he color codes it. No, these are like really narrow differences in what quad it could be. It's really the signal on what is going to manifest as the trend. Clearly, what's manifesting is inflation's reacceleration. So I'm positioned for quad 3 and have been, you know, since that turn, and that's been absolutely the position to take, even if we have another quad 1 on paper in the third quarter. Doesn't matter, you know. So I'm going to be long what I'm long because I'm going to stay with the signal and the process. I'm not going to sit there and try to oversimplify something that is highly complex.
Okay, this is from Alan. Your commentary around point 2 this morning's early looks, or this morning, I think we talked about point 2, either in the early look or on the sheet, but seems to imply you believe the Fed will raise rates in the next meeting.
I didn't say that.
Is that yours or?
I didn't say it, or I would have written it and said it. So it doesn't seem to imply, like, when Keith thinks something, he said.
That is true. We all know that.
Yeah, okay, so, I don't know what the Fed's doing. Basically, you know, the powers that be told the Fed what to do. And let's just call it what it is. I mean, multiple times when Wall Street didn't get what they wanted, like throughout the month of August until you got your month-end markup, they asked for something, right? Just like January to June of 2022. They're like, we need a rate cut. So they were pricing in rate cuts back then, don't forget. Priced into Fed Fund 2, right? Because you can manipulate that if you have the big order. You have the big stick. They know it, right? So they just basically told the Fed, hey, look at this over here. Hey, no inflation over there. Wait here, Schultz! This is why people are pissed off. Because the elites can do that, right? There's the state, there's the elites, and there's the rest of us, okay? So what I'm saying here isn't, I believe that they tell the Fed what to do. I believe that the Fed may not raise rates in September because they're telling them what to do. That's why I wouldn't say something like what you just said or imply it. Okay. That the Fed should raise rates in September, yeah. I mean, based on what he said he's going to be waiting for incoming data. And to Jonesy's point, even on the headline of the labor report, if you add back whatever, also on the revisions, they were way worse. But if you were just to look at the number one thing that matters to the Fed right now, inflation acceleration, and you look at the PCE number, you look at the Fed's, the Fed's favorite component of the PCE number, which is again backing out rent, which is up 4.6%, not up 2, not up 3. If you look at the CPI that's coming up next week, what the Fed should do is what I'm going to be doing is trading rates, not what they're like. I don't sit here, and it's a fair question because you got me to react to something that I obviously have thoughts about because I've thought about it quite a bit. We're entering this period where, once again, don't forget that Wall Street, since the beginning of my time on Wall Street, almost a quarter of a century, they are always the catalyst for their own demise. Okay? They put the Fed in a position where, again, being macro unaware, they're all in, whether they understand it or not, they're putting themselves through the begging and pleading for cowbell in a position that's actually worse than they would have been if they just let gravity, imagine that. Imagine you just let gravity play out its course. And that's the real thing that I believe. Human beings, central banks, Goldman, I don't need to name the firms with a B. I would never say I would never say Blackstone, would I? I mean, these firms need something to happen, but economic gravity is happening. And that's a big difference. So we'll have to see how this trades. But again, it puts Wall Street in a real tough spot, Jonesy, because now Wall Street is expecting no rate hike, and Powell, what if he does?
Yep.
If you're looking for a catalyst to crash the stock market, I mean, there's one.
If you just separate yourself from the noise a little, go back to what Powell said, like if I thought was, hawkish or
Crystal clear.
or at least he's going to be very diligent on inflation. And then since he spoke to Jackson Hole for what's transpired, for the labor market hasn't moved at all. You had stuff back so it's actually gotten, on the margin stronger and inflation is accelerated. So he said he's going to be diligent, probably raise again, whether it's this time, next time. Certainly
instead of saying, like going to your boss, or if you are the boss, saying, he's gonna raise rates, just be positioned for rates rising. I mean, last week was awesome. It wasn't just my long book that was working. I mean, I'm long energy and I'm short utilities. That's a 500 over a 500 basis point spread last week in terms of what these sectors did, okay? And that's after somebody were like, what are you trying to do utilities? Just stop it, man. Like, put the positions on, like them or love them or hate them, it doesn't matter. If they're working for the right reasons, I'm gonna remind you that this isn't about what's in your head. It's about what's in my process, okay? So let's look at this. I mean, last week, XLU versus XLE on the week, this was up 3.6%, and utilities were minus 1.6%. That's pure, unadulterated alpha, right? I wasn't short Qs, I was short XLU, okay? I'm not short Qs on the open, I'm short EWH, Hong Kong. So again, get yourself to a place, if it's closer to how I'm positioned, if not copying it, then I think it's fair that we're gonna have a much better conversation as we go through September, the upcoming fourth quarter, the upcoming 10 years of your full investing cycle. Because I should be held responsible for what I'm doing, not trying to correct everything that you may have done otherwise, okay? I think that that's fair, because we have so many subscribers that it's an unachievable goal, even if you want me to run your book. I think you'd have to say, okay, what did he do? Can he hold himself to account on that? 100% of the time I will, and that's where we're at. Rate sensitivity is the way you play this, not betting that the Fed has to raise rates. Yeah, rates are up. We just got paid anyway.
All right, we're gonna wrap it up there. Went into a little overtime. Thanks everybody for tuning in. Back at it tomorrow morning at 9 a.m.
Hey, good morning from the control room, everybody. Eric Jenner here, producer of Hedgeye TV. We got a busy week on Hedgeye TV. Today, 11 o'clock, we have a real conversation with the entire Tier 1 Alpha team. That's going to be a fantastic conversation with Keith right here in the studio. All three of them, great conversation about their process and how Tier 1 Alpha is folding into the Hedgeye process. And that's a great product. Go check out the market situation report. They have a weekly webcast involved in there as well. Tomorrow we have a webcast with David Salem talking about his capital allocation product that is launching. And then Thursday, as Keith alluded to, we're going to have the macro themes. So for a busy week. And don't forget, retail show, consumer show, industrial show, all this week. Have a good day. Have a good day out there.
Everybody moved out, right?
55 minutes to, like is it 20 minutes or something less than that? Yeah. It's it is what it is. It's traffic, and thank you for bearing with us. Welcome back from your Labor Day weekend. It is time to labor. Top three things this morning. Europe going to hit on that. Oil and then interest rates. First on Europe. I mean, we're talking. Obviously it's a recession in Europe right now, and it's only obvious to those of you that are subscribed to this, as opposed to the old wall media and all that cabal. This is getting worse at a faster rate. So you're seeing like these business confidence or business activity PMIs at a 30-month low. The UK, of course, is not Europe, but those numbers were horrendous. When you look at the services sector in the UK, and all I can say about all of it in Europe is that it's some place oscillating between quad 4 recession and quad 3 stagflation. So if you ask the European consumer, you ask the British consumer, you ask the Irish consumer, nobody really cares about what we think up there, but hey, if you ask us, we'll tell you. It's stagflation. The cost of living remains sticky and high, and now you're starting to see the commensurate slowdown in the corporate sector getting pick up on the downside as it does during a recession. So when you really think about positioning in Europe, number one, we've nailed it, in particular on the currency trade from last week. But that's not just the trade, that's a trend. You can see that this morning in the early look where I go through why the dollar is so strong this morning. It's up again against both the euro and the pound on this data, by the way, which is a great position for us. And consensus completely got it wrong. So when you really think about like what do they really know other than their charts, absolutely nothing when it came to the dollar. And translating that to a weakness in Europe relative to their views on that policy. So that's where we're at on that. If you look at the European, the France. Trends to vertical on fumes, even for Apple, and no matter where you go, there it is. It was a big 3-4 day rally into month end, and that's all you got. But the economy continues to slow into quad 3 stagflation. End of 10 times. Got I cited it last week. I didn't see it this book. This is a phenomenal book. Okay, this really puts what's going on in context here for the many of people. And you know, it's borderline disgusting to hear people just talk about, okay, well, rich people are fine. Like, this is ridiculous at this point. But I mean, the guy makes a very good point here, Jonas. He actually says that the America we have today is similar to the 1950s, in that between 1820 and 1860, when you look at relative wages, like the money that the people get relative to the 10%, us, to be clear, we're in the 10%. Okay? I'm not saying I'm not. I'm just saying that I understand that 90% of the population still matters. Okay? So in the 1920s and 60s, the relative wage, or the share of economic output paid to each worker, declined by 50%. 50. Okay? So we're in the same kind of 5 decades since, a long time since we've had the 1970s type thing. But it's what people are struggling with every day. It's why consumer confidence continues to slow. It's why people are just generally distrusting of the data and of the government itself. Oh yeah. That was muted, but yeah, it'd be interesting to overlay that with meal cycles. Yeah, what he does here, it has demographic components to what he's saying. But what he's really doing is digging deeper into the nature nature of each economic collapse, in particular the Chinese one, the European ones, from if you actually dig into France in the 13th century, we've done that. I mean, it's like really, really good work, really good book. If you haven't read it, it's okay, I already have. You can listen to it, you can read it, but it's being incorporated into the process in as much as volatility, shorter-term data. And that's the key. It's so much work. It's so much easier just to say, stocks go up, right? Think about that. It's not just an ideology or a compensation structure for many, being a permabull, which has got dire consequences over a long-term period or for your full investing cycle. Many of you work so hard for your capital. When you think about it, it's just a lot easier. I mean, imagine having to do all the work across durations, trades, trends, and long-term tails, but then contextualizing that tail and understanding demographic reality within the context of like short-dated vol option trading. Tough. Not tough for me, tough for them, so they just rather say stock or long, okay? Many of these people are still in an epic drawdown, by the way. Imagine you're still long Bitcoin. Tough week, tough morning, really. There's no institutional manipulation there, like you have obviously in the month end for the SPYs. 43.35. Not much movement here, even though volatility got smushed on super short-term vol at the low end there, Josie. So you got 45.41. That's an interesting setup, okay? Obviously, where we have now almost 5-1 on the downside. So on a long-short basis, I have 0 longs. I think that's pretty clear for those of you that saw me selling into strength last week. Those are all gone, all the longs. I have 9 shorts. This is, of course, not a portfolio, but it's a good proxy, and it's a great coaching tool, okay? So in my long-short book, I'm at minus 14.5%. Again, I had a very good week in a lot of different things, in particular my longs. So you can see that long-only book. Jamie Bruno is like, people don't all want to hear that you're hitting all-time highs. Well, what do you want me to talk about? What do you want? I mean, last week was one of the best weeks I've had in years. I mean, I don't know what, it should be yours too. I mean, we had a lot of things that were going up a lot. A lot of you are long, obviously, things like FDRXX or T-bill or whatever, where you get payday. There's a lot of good that's going on in terms of our process on the long side, and I'm not going to stop talking about it, okay? What we really got to do is get those of you that didn't do that in a better position where you're executing so that your longs, again, I think I have 23 or something like that, long positions are closer to mine, and you're working the sizing. We're working on different tools and products here at Hedgeye at different price points for you to get that a little closer to real time. Of course, we understand that Macro Pro is an expensive product, but again, I think it pays for itself, or at least that's what the feedback's been. So no matter where you go, here we are. Those are the position changes that I've made, and those are the results. Okay, what else we got going on for you this morning? The VIX 1309, again, smushed it right into the close. Top end of the range comes down inside of 18, which is new. That's why the top end of this range went up, and this is kind of unchanged, sort of unchanged, so to speak. What else we got going on? VIX in, NASVOL, again, I think it's the 3rd day in a row where NASDAQ volatility is, again, testing this area where it's failed to hold like a ball underwater. So again, below 18.5, it's rare that it stays there, and I don't think that it's going to, but we'll have to see about that. We obviously have an open mind. I do not have a position, obviously, in the NASDAQ or in the XLK itself. That came off ETF Pro, or it should when I give the monthly update this morning, because it's back up. It's a bullish trend. I mean, if something goes for a day in there and it goes back to bullish trend, like, what do I care? Get out of here. Right? Just get out of here. Get out of my life. You don't have to be here. Just put it in a new position. Short Austria. Why not? Why do you have, some of you have such, I know why, but the fact of the matter is you shouldn't care. Shouldn't care whether you're short QQQ or EWO. Just inventory. Just units of risk that you're using to hedge your book. Right? That's it. Doesn't have to be what Wall Street needs. What are your positions? Be dispassionate, apolitical, certainly, on what those positions are. Looking at Friday, 511 sectors were actually down on Friday. Volume was down the world. I mean, so again, you had updates. You had big open on the upside, and then it failed for the day, and it came up. No real volume. Move index all the way down to 103. Getting some questions on that. That's also because Treasury bond vol can go away in a couple of big different ways, and this is one of them. This is where interest rates aren't really going to go much lower than where they were at the low end of the range, because that's flat. Right? You go from 405 to 421. Clearly, that was a pretty damn good setup for you to volatility coming out because interest rates really won't go down or break down through trade or trend levels that matter. So that's interesting. So it doesn't mean I'm gonna be buying duration, that's for damn sure. I like my shorter term duration. Of course, the FPRXX, high yield, right at the spot to be adding to short, so hopefully you did that. And then understanding, that we'll see where that goes today, of course. Asia last night, Japan up, India up, good. China down, good. So those are our positions, and we're sticking with them. Hong Kong, BWH was down. Hang Seng was down. For BWH, we're long INDA, INDY, we added to those. It's up in the re-rank for the asset allocation, another good decision that we made in terms of core asset allocations. And Japan has obviously been great, in terms of doing what it should have done. And again, in the middle of the month, people are talking a lot about how this rally came back. Well, what they really got back was the things that they were all long together that were going down. Now, what we did was, I told you to buy energy and buy Japan and India. Now, again, energy and Japan were bigger, and then India became bigger. So that's what we're going to do what we do. That's it. We're going to execute on our game. I've been saying this to my kids all weekend, Callie and Jack, because they're back at it in hockey, 13-year-old, 50. Like, don't worry about what these other kids are doing, what their parents are telling them to do. We have a plan. We're going to do what we think we should do. Fair enough, so shit. So when you really think about what they're forced to do in markets, more than 90, a much larger percentage of these people, A, have either never risk managed a cycle correctly, or B, actually been in the game for a whole investment cycle. Don't worry. Don't worry. You have the country club on. We have a day. I'm fighting green. You got some guy. A lawyer or a dentist telling you what to do. That's fine. I want the lawyer to lawyer, and I want the dentist to clean his chops, but I don't want them to call me anything. Okay? Keep going for us. We got some Europe. We go down the short side. Already talked about that. Already talked about oil, gold. I'm oscillating in there, just trying to help more people all the time. People go, oh, can you show me the GLD risk range? Can you show me spot? Can you show me COMEX? Today it's spot. The other day was GLD. Please don't do it. You could generally know, what you should be doing there. You can do it. I think you can at least. I can. I'm adept at doing that. It's not a high level play, by the way. It's just what it is. Gold volatility 11 to 28. It is. Silver down here. I'll be buying some of that today. That moves back into the asset allocation on red as it should. Already talked about bond yields again up a lot since where that was. That big low in the range, 24,805. Big lower high.
That was fascinating.
Lower high.
Had you chased that, you'd be down on the ETF, up to 10, not more.
I mean, if you were buying whatever Rug Paul's latest chart was saying, you're already down 20+% year or whatever. The fact of the matter is that that's a bear market. Everyone can see it in crypto. People on Wall Street are generally not compensated by crypto. We got a whole other animal here with mother of all bubbles, the year to date, et cetera, but it's the same thing. It's the same thing, which is speculative assets without institutional support or one-time markup look a lot like Bitcoin, and or worse if it's some other shit. All right, let's take a question.
Okay.
Did I mention in currencies, by the way? It's been a while, but you have a trifecta this morning, and what I mean by that is you have all three majors, at least according to me. That's why I published them. Canadian dollar is not one of the majors, although I do publish that risk range every day and the signal's been there. Which is surprising given oil's been. But again, I like surprises. I don't need surprises. I don't have that. So the big three, yen, euro, and British pound are all signaling bearish trade and trend versus the dollar. So for those of you that stayed with the process instead of people's white papers on the demise of the dollar, well done.
Okay, big news today. Questions about this. Goldman reducing their recession forecast in the next 12 months to 15%. 35% in March, 20% July, 15% now. Labor market's strong, inflation's decelerating. All is good. Thoughts on that?
Yeah, on the other side, Goldman's process was trading recession. Yeah, so the recessionary odds for and no cut in September. So of course Goldman's research is different than it's a different time. But that notwithstanding, a couple things. One, I'd say the odds of recession in the third quarter being reported have going towards almost zero. So they're wrong on that. Q3, we'll walk through this on Thursday. Major league government spending that has not been curtailed. Again, there's some dynamics inside of the numbers that keep GDP positive. Okay, it could be positive 2-3+% if we're on a headline year over year. But it's the fourth quarter and then the first quarter that again that takes the probability up that you have recession in the first and the fourth quarter. That's where we have it tracked. Again, when you do it the way that Jonesy does it, do it the way that Drago and I and Drake and the whole team, Steiner obviously, Richie, Rooster, perfect. Don't want to double count. Tex, Burnett, we're all there. Is that markets and economic probabilities are all about counting the stochastic nature of these things and having what we call Bayesian inference process. Therefore, as the data changes, we change. We don't sit there and slap up 15% probability on a recession when the recessionary odds are dropping in the third quarter and ripping in the fourth quarter into the first. So that's a much better way, obviously. Again, if you think about it like traffic today for me, Goldman would say, well, my optimal model says that the probability of Keith getting there in 43 minutes is X. You know, when the reality was that the thing changed as I was in the car material. That is, again, updating for real-time information, real-time data, either accelerating or decelerating as the car is. So again, we're doing it the way everything else in your life goes. They're doing it bullshit, right? That's what you've always believed, but you never quite had somebody giving you specifics on how much bullshit there is.
Well, you know, the one thing from, I don't think John Hodges, the big part of what he's talking about is employment, right? And, you know, actually, to his point, employment, you know, you add back the Hollywood, like, Yellow Banner, employment is actually a lot better than 20 or something. But employment is the classic of like the indicators. So you get, you know, pointing to that, and then inflation has done really nothing but accelerate in the last 6 years.
Well, you go back to the last two recessions you on this call. Labor's always looks very, very good. And actually, so does GDP. I always remind people, you know, in the third quarter of 2007, GDP had a 2 handle. Just like it might even have a 3 in the third quarter. The third quarter, by the way, ends in, you know, the market's really trading stagflation. So again, I know it's easier when we talk about easier, right? We're 50 days in the month, we're in the middle of July. Terrible. Okay. Quad. I like it when color codes a quad. No, these are like really narrow differences in what quad it could be. It's really the signal on what is going to manifest as the trend. Clearly, what's manifesting is inflation's reacceleration. So I'm positioned for quad 3 and have been, you know, since that turn, and that's been absolutely the position to take, even if we have another quad 1 on paper in the third quarter. It doesn't matter, you know. So I'm going to be along what I'm doing because I'm going to stay with the signal and the process. I'm not going to sit there and try to oversimplify something that is highly complex.
Okay, this is from Alan. Your commentary around point 2 this morning's early looks, or this morning, I think we talked about point 2, either in the early look or on the sheet, but seems to imply you believe the Fed will raise rates in the next meeting.
I didn't say that. I didn't say
that.
it, or I would have written that instead of it. So it doesn't seem to imply, like when Keith thinks something, he says.
We all know that.
Okay, so I don't know what the Fed's going to do. Basically, you know, the powers that be told the Fed what to do. And let's just call it what it is. Multiple times when Wall Street didn't get what they wanted, like throughout the month of August until you got your month-end markup, they asked for something, right? Just like January to June of 2022. They're like, we need a rate cut. So they were pricing in rate cuts back then, though, for you. Priced into Fed Fund Future, right? Because you can manipulate that if you have the big order. You have the big stick. So they just basically told the Fed, hey, look at this over here. Like, hey, no inflation over there. Right here, Jules. This is why people are pissed off. state, there's the elites, and there's the rest of us, right? So what I'm saying here isn't, I believe that they tell the Fed what to do. I believe that the Fed may not raise rates in September because they're telling them what to do. That's why I wouldn't say something like what you just said or imply it. Okay. That the Fed should raise rates in September, yeah. I mean, based on what he said he's going to be waiting for incoming data. And to Jonesy's point, even on the headline of the labor report, if you add back whatever, also on the revisions, they were way worse. But if you were just to look at the number one thing that matters to the Fed right now, inflation acceleration, and you look at the PCE number, you look at the Fed's favorite component of the PCE number, which is again backing out rent, which is up 4.6%, not up 2, not up 3. If you look at the CPI that's coming up next week, what the Fed should do is what I'm going to be doing is trading rates, not what they're like. I don't sit here, and it's a fair question because you got me to react to something that I obviously have thoughts about because I thought of it quite a bit. We're entering this period where, once again, don't forget that Wall Street, since the beginning of my time on Wall Street, almost a quarter of a century, they are always the catalyst for their own demise. Okay? They put the Fed in a position where, being macro unaware, they're all in, whether they understand it or not, they're putting themselves through the begging and pleading for cowbell in a position that's actually worse than they would have been if they just let gravity. Imagine that. Imagine you just let gravity play out its course. And that's the real thing that I believe. Human beings, central banks, Goldman to, I don't need to name it firms with a B. I would never say I would never say Blackstone. I mean, these firms need something to happen, but economic gravity is happening. And that's a big difference. So we'll have to see how this trades. But again, it puts Wall Street in a real tough spot, Jonesy, because now Wall Street is expecting no rate hike, and Powell, what if he does? If you're looking for a catalyst to crash the stock market, I mean, there's one.
If you just separate yourself from the noise a little, go back to what Powell said, it was kind of hawkish or
Crystal clear.
or at least he's going to be very diligent on inflation. And then just go to Jackson Hole with sort of what's transpired. If the labor market hasn't moved at all, you had some back. He said he's going to do due diligence. Others raise the analytics for that. Certainly not the lower. So, you have to think about what he said, what happens.
Right. Now, instead of saying, like going to your boss, or if you are the boss, saying, he's going to raise rates, just be positioned for rate hikes. I mean, last week was awesome. It wasn't just my long book that was working. I mean, I'm long energy and I'm short utilities. That's a 500 over a 500 basis point spread last week in terms of what these sectors did. Okay? And that's after some of you are like, what are you trading in utilities? Just stop it, man. Like, put the positions on, like them or love them or hate them, it doesn't matter. If they're working for the right reasons, I'm going to remind you that this isn't about what's in your head. It's about what's in my process, okay? So let's look at this. I mean, last week, XLU versus XLE on the week, this was up 3.6%, and utilities were minus 1.6%. Pure, unadulterated alpha, right? I wasn't short Qs, I was short XLU, okay? I'm not short Qs on the open, I'm short EWH, Hong Kong. So again, get yourself to a place, if it's closer to how I'm positioned, if not copying it, then I think it's fair that we're going to have a much better conversation as we go through September, the upcoming fourth quarter, the upcoming 10 years of your full investing cycle. Because I should be held responsible for what I'm doing, not trying to correct everything that you may have done otherwise, okay? I think that that's fair, because we have so many subscribers that it's an unachievable goal, even if you want me to run your book. I think you have to say, okay, what did he do? Can he hold himself to account on that? 100% of the time I will, and that's where we're at. Rate sensitivity is the way you play this, not betting that the Fed has to raise rates. Yeah, rates are up. We just got paid anyway.
All right, we're going to wrap it up there. Went into a little overtime. I'm sure we'll continue it back on.
Hey, good morning.
Mom, don't forget, you can customize and save with Liberty Mutual. Let me add another reminder on my phone. Can you believe it was like 6 weeks ago that we drove by? We did it.
Okay, that was 30 years ago. Well, 26 years ago. And of course, nothing happened. Bank of Japan didn't know QE anyway. There's never any reason from the beginning to think this was a policy that was going to have any effect on anything. Whether it's QE or QT, it doesn't. Now, they definitely have placebo effects because people think it's going to do something. And if you're on a gold standard, it would certainly do something because now all that money could be converted into gold, get the gold out of it. That's not. In floating exchange rate policy, there's no reason to think it's doing it. And now we've had 30 years of demonstration in Fed research, and BOE research, Bank of Japan, BOJ research, and they can't find anything except what they call placebo effect. When it gets announced, markets will move because people think it's going to do something and then fizzles out. So they have plenty of that, but they don't have any actual channels from QE to inflation. And it just doesn't exist.
So could you also say that that is in part a swapping of one government liability for another, and if you look at it through the M&T lens, then that doesn't matter because all that matters is liabilities that can help you pay taxes.
Yeah, so it's not even, the liabilities are still US dollars. It's just one liability you can access overnight, the other one is term, so it's even less, you know what I mean, even more so to what you said. And so there's, you're just switching your dollars from one account of the Fed to another account. You still have the dollars. You're doing it voluntarily, presumably because you want to spend them in August, otherwise you need to switch them.
Hey, and Warren, I have another question.
Yeah, sure.
So this question is by Terry Moore, who asks, can MMT actually work if it's liable to be abused by governments/monopolies? Yeah, I think this also relates to a sentiment that I come across often, which looks at money as something that the government will abuse, devalue at the expense of savers.
Okay, but MMT is a framework for analysis of the monetary system. It's not something you use or do. It's not a policy. And once you understand the monetary system, you're more likely to cause damage to your population than good, maybe. Either you believe in an informed electorate or you don't. And a lot of people don't think the electorate should be informed. They think, oh, if people ever knew this or if people ever knew that, everything would go to heck. Right? But I personally believe in an informed electorate. If you don't, if you think it's better if people don't understand how things work, that's fine. We each have a vote in the election and we'll see what happens. But that's what the question comes down to. But do you believe in a representative government that's informed or you don't?
Yeah, so MMT teaches us about the world, but it doesn't necessarily say how governments should run it. However, there are, and this was another question I got on a post previously, there are quite a few MMT economists, such as, for example, Stephanie Kelton, that do seem to be quite prescriptive. And you also sometimes, I think, maybe, for example, say, well, actually the proper interest rate for Turkey should be 0, which is also prescriptive, right? How do you look at these two?
Well, you can look at it that way. What I say is, when any government pays interest, they're paying out money, currency, tax credits, and they're increasing their deficit spending. When you increase deficit spending in the market economy, just completely on the supply side, you're reducing, you're putting pressure on your currency. And if we look back at the Buckaroos, and I was asked, it was actually Matt Forstad said, he's probably wanted to pay interest on Buckaroos or something, was it Matt? No, Andrea wanted to pay interest on the Swiss francs, and his franc and francs. Well, let's say you gave all the students, 100% interest on their savings, 1,000% interest on their savings. How much work would they do? Would they go over to volunteer at the hospital if they could just make the money on interest? No. So the total amount you can spend goes down when you start paying interest. If you try and spend the same amount by paying higher prices, which governments tend to do, now you're just driving up prices. You're causing the price a little bit, and you're redefining your currency downward every time you pay more, which you're driven to do, not understanding the system, every time you pay more interest. And you can see this happening, all over the world as they raise rates, if the debt is high enough, where the interest payment is meaningful. And the public debt's very low, it's de minimis, you can't detect it. But once you get, the U.S. at 120% of debt to GDP, every mainstream economist was warning us about this 10, 15 years ago when we were at 50 or 60%. Debt gets too high, all that interest is going to cause inflation unless you raise taxes. You can't just raise, a problem with public debt is eventually you're going to have to raise taxes or all the interest. Here we are. And the interest is causing inflation, so stop paying it. And the other thing is, when you're, there are a lot of people that favor like basic income. Well, paying interest is a form of basic income, but it's only paid to people who already have money and in proportion to how much they already have. I mean, you can't imagine anything more regressive than that of government policy. And that's what we're doing. The Fed has decided to increase rates from 0 to 3.5, paying 3.5% basic interest income to people who already have money, in proportion to how much they already have, just flooding the economy with these $1 trillion and saying this is how we fight inflation, by giving people with money more money. That's all they do. There's no other policy that changes at the Fed operationally when they raise rates, except they turn on the fire hose and start pumping more money out into the economy.
But Warren, isn't there one difference between our Buckaroo University example and modern economies when it comes to interest rate, in the sense that you at this point seem to be talking about it mostly as you pay out interest rates, and I understand that the government is a net payer of interest rates.
Yes.
However, part of the interest rate instrument is also that a lot of banks essentially borrow from the government, aka the central bank basically. And a lot of the channels that traditional economists talk about go through that. So it doesn't go through paying out interest rate, but it says, if we're going to charge higher interest rate for banks to borrow, they will charge it to the customers, and that will reduce investment and spending.
Right.
Does that fit? How does that fit in?
Well, in this case, let me start with the real world and then I'll go to the real. So for every dollar borrowed, there's a dollar saved. Now they don't, banks don't take government money and lend it. Okay, the loan itself creates a deposit, right?
Yeah.
Causation from response. So even though they might get that, the actual, the government credits the bank's reserve account, and then the bank makes a loan, the reserve account doesn't go down, it stays the same. Okay, but on their books, when they buy your signed note for your home mortgage, they credit your account with a new pounds or new euro or whatever, and new dollars over here. And they keep the loan on their books, so they have an asset and liability. They don't, the dollars that they got from the government have nothing to do with that. So they might get loan guarantees from the government. So now they're not, now they will buy your signed note, where before they wouldn't do it, because J. Powell is guaranteeing your loan. But that's a different story. So number one, what you said though is how a lot of people think about it, and it's just not reality. It's just not how it works. So that's a distortion that creates, again, confuses conclusions. So, but in the economy, for every dollar borrowed, there's a dollar saved to the penny, or some accountants going to stay away from this mistake. Banks have assets and liabilities to report with loans, and you have deposits. Now you've got net worth, which is a form of a deposit, but you've got deposits somewhere in the system. And they're equal. And so whenever rates go up, borrowers pay more, but savers get more.
Mm-hmm. Yeah.
So the borrowers pay more. So the question is, which one's more powerful? Yes, borrowers have to pay more, so that hurts them. But savers get more, so now they can buy more products from the business that was borrowing, and so they can afford to pay. If those two are equal, if all the money that the borrowers paid in interest was spent, then there would just be a shift in wealth within the economy, which could have distortions we don't want to have, which could be unpleasant distortion, but it's still just a shift. If there's a difference, then there can be a difference in the overall spending, GDP, the whole economy. Those tendencies to either spend or not spend interest income are called the propensities to consume interest income.
Yes. Yeah.
Called the propensities. And so the Federal Reserve studies these propensities to see, are they different? Do borrowers get hurt more than savers get help? Do borrowers have to pay more and savers don't spend more, they just let it pile up? And there's a guy at the Fed, I visited Steve Oliver, he was officer for 20 years, he retired from years ago. That was his job. And he said, well, the answer he gave right to the end, which he retired, was, what we believe that there is a difference in these propensities, and that it does hurt the borrowers more than it helps the savers. He says, I've been doing the econometrics for a long time, I can't detect that. So, okay, so the probably is.
When did he do that? Like, when was his, what years are we talking about?
He probably retired 5 or 6 years ago.
Because I could imagine that as wealth inequality shut up, that the propensity difference becomes bigger.
Yeah.
So just
I agree. We don't know. So all we can do is look at the data, because you can't measure it. It's very hard to measure. Well, yes. So you look at the data. When we raise rates, does the economy pick up, or does it actually slow down?
Mhm.
And I was
Yeah.
looking at this back in 2008 when they were cutting rates. We were at 60% debt to GDP. You know, out publicly saying, I think these lower rates are going to slow down the economy because the income effect is going to be a lot stronger on the savers than the borrowing effect. You know, we're not going to get this increase in borrowing to offset the decline in savings. The propensities might even be running the other way. And you can see for 10 years of zero, and why did I guess that? Because I looked at Japan. Now, Japan had much higher debt to GDP, but they had zero rates for 20 years back then. Didn't have runaway borrowing or anything else. So I didn't think, that's in the opposite direction. I didn't think borrowing was going to get helped by the lower rates. And a lot of this is just looking at the data. It's experience. I remember years before, I was on the phone to someone in Australia. This must have been in the 70s, mid 70s, maybe late 80s. And I said, how's the real estate market? Maybe late 80s. He says, you know, it's pretty good now. You know, mortgage rates are 17 and a half. He said, but I think if they put them up to 18, it's going to kill it. I go, okay, thank you. You know, I was a trader, I was a financial center, money manager. Then I call somebody in Japan, how's the real estate market? He says, horrible, you know, the rates are 3.5. He says, but I think if they put them down to 3, it's going to pick up. So I'm going like, all right, how important can rates be? Has to be other things that are important. We had 7% mortgages back in 2006 and 7, and we had like twice as many mortgages as we had, you know, 10 years later when mortgages were 3.5. And there's just other things. In the late 70s, everybody in my generation, their first mortgage was 15%, 17%. And, it, you know, and that's, oh yeah, I remember when I bought my first house, mortgages are higher. That doesn't have to get, but if you look at the housing starts and the mortgages back then, it was higher than it is today. On a per capita basis, it was much higher. Okay, because there's other things that drive these markets, and with rates, not that powerful. You know, they make headlines and they talked about, but you go back, you know, we peaked at 2.6 million housing starts, I think, my first year working with small savings bank. At 1973, it was 1972, we peaked at 2.6 million. Mortgage rates were 8%.
But
Okay, we only had 200 million people. We have twice as many people today, half as many mortgages. Where rates are half. You know?
But-
It's like, okay.
But Warren, isn't there like, okay, I read some literature on this. If you say to a commenter, oh, QE doesn't seem to have such a big of an impact on at least inflation and perhaps on asset prices, well, there I've
Right,
definitely
right.
read research, especially for the first proposition, that
Yeah.
you know it's very difficult to find. But
Right.
I do think there is a lot of research stating that interest rate changes can have a very high have a high impact on
yeah.
asset prices, right?
Yeah, they'll affect it, sure, because asset prices are interest rates. Bond price is the interest rate, but so what? Does a bond price change? If you buy a 4% bond and then it drops in value, you still get your 4%. You know, that you contracted for, your pension fund, you still have 4%.
Sure,
I mean,
but
you get
for
those
house prices, it matters a lot, right? If you change the interest
Oh,
rate,
yeah, but look-
like
look at-
now, for example, that they're
Alright, but
going
look
up.
at- look-
A lot of my peers are having more difficulty buying a house now than I did when I bought a 1%.
Yeah.
So
Okay,
that's a
and
big
I
impact,
don't-
right?
I don't disagree, but if you look at housing prices from 1960 to today, they pretty much just go up all the time. And if you look at the big inflation and the high rates of the late 70s, they kind of flattened out a little bit and then went right back up. You didn't see like a drop down or reversion to the mean or anything like that. They just keep going up.
Mhm.
You know, with inflation, no matter what the rates do. Because the rates are taking away from the borrower, but the saver's making money. And the parents, I'll just talk anecdotally as long as you will. The parents give the kids the money for the down payment, or they get more money at work because they need to work and they have to live somewhere, so the boss has to pay you enough to make your interest payment, or you can't have any employees, right? And the selling prices are high enough because people with money will pay it so that he can pay you enough to afford a mortgage. And you'll get a few months of dislocations. It doesn't usually amount to much more than that from the interest rates. So now I look at this last cycle, which is what, 6 months now, they've been raising rates
Mhm.
fairly dramatically.
Yeah.
And it's supposed to slow down credit and borrowing. When you look at real estate loans in the banking system, they're going straight up. Consumer loans are going up, and people say, oh yeah, well, people are forced to borrow instead of pay cash. Okay, you can make up all these stories, but it sure hasn't slowed down the credit expansion. It sure hasn't slowed down GDP. We had 2 negative quarters based on inventory adjustment from wildly overbuilding inventory from COVID. Now, once that's been adjusted, it's back up, and then St. Louis is
Yeah.
GDP now is back up to 2.8% with the rates going, and Biden said yesterday, President Biden, the US economy is strong. Yeah, it is. That's paying out, 3% of GDP, the equivalent, no, now, but it's approaching 3%, it will go to 3% of GDP. New deficit spending on interest. I'm saying, it doesn't look like that has no effect. It looks like that's a huge amount of money and it's having an effect, and it's regressive, I don't like it. But it's, the reality is we took a regressive economy and made it twice as regressive by raising rates and supporting it from the top down. We doubled down on trickle down. Trickle down works to some degree. I don't like it. I think it's obscene, but it works to improve the numbers, whatever that means. And, GDP numbers, and that's what's going on. And it makes it tougher and tougher to fight it, when people kind of manipulate the data to show that it works.
So one thing that's definitely clear to me is that the way that you think about this, and perhaps by extension the way that this is thought about in MMT is a completely different lens to view things through
Okay, well,
than economists typically do.
This is not even MMT. This is what every mainstream economist, this is what Paul Krugman told me when he was arguing with Stephanie Kelton in the,
Sure. No, but what I mean
Bloomberg.
is more sort of this. So how I look at it is like, okay, if we talk about interest rates going to the economy, we talk
Yeah.
about different channels,
Yeah.
right?
Yeah.
And a lot of the economists tend to focus on borrowing type of channels, and you tend
Yeah.
to focus on the saving type of channel. And
Well,
I think a lot
look
of
at the combination, yeah.
yeah, sure, but I think then sort of
Think macro, yeah.
economists disagree then on which I think most economists would recognize that there are a lot of different channels, but then the disagreement
Well,
comes
let me give you an
on how
example.
big they are, right? And
Let
I
me give you an
think,
example.
Sure.
I was in a conversation with Paul Krugman, I haven't been in a long time, but a few years. I said, what's wrong with, you can run deficit spending to sustain full employment, job guarantee. And that's the economy savings society. There's no limit to that. He says, well, yeah, because if you let that debt get too large, then the Fed can't raise rates to fight inflation because that interest will be causing inflation. That was his argument against the job guarantee and against excessive deficit spending to sustain full employment in general. That was the argument, okay? Now, he's saying, oh, these high rates are, the Fed's killing the economy, it's the same guy. Right? So you can't call it, I don't think about MMT or not MMT, mainstream or not in mainstream. It's the same guy. It's only been a couple of years. So, maybe the politics have just clouded their analysis. Maybe I've stripped away the politics to just look at the numbers, and if you don't like them, sorry. But if these guys don't like them, then they don't see them.
all right, Warren, this provides me with the ultimate bridge, basically, to this section I had planned in the middle, because I think the section we've now sort of entered, like talking about interest rates, but the differences between the simple university type of money and the real world, it gets complicated. So maybe to sort of let everyone process that a little bit, I thought,
Okay.
right in the middle, let's play a little bit of a game, which I call myth, MMT or myth. So, because
Okay.
a lot of people have lots of opinions about MMT, and they'd like to tweet about it, and so I was, I always get these questions, is this true about MMT or not?
Yeah.
I don't know, let's
Okay.
ask
Good.
Warren. So I have a slide here so everybody can see it, but I will read it to you. I have an article from Paul Krugman, so this is
Yeah.
the little bridge, and he says, in the New York Times, fairly well-known newspaper, deficits and printing press, somewhat wonkish. Right now, deficits don't matter, a point borne out by all the evidence, but there's a school of thought, the modern monetary theory people, who say that deficits never matter, as long as you have your own currency. Is that MMT or myth?
Okay, so first it needs a little context. For solvency purposes, they never matter. The government checks will never bounce. The government can always spend another dollar if it wants to.
Yes.
Second of all, at any given point in time, the deficit is residual, and that equals the real savings desire of the economy. Now, if it gets large by paying interest that nobody really wants, then you will get adjustments to the price level so that the government will wind up paying higher prices, and that will, I'm trying to get it tied back to your question. So the deficit per se doesn't matter ever. It doesn't create a condition where the government checks will bounce or they're going to cause inflation. It's a residual. The government check deficit always reflects the residual savings desire in the economy at that price level. By definition, it's a market determined thing. By definition. So that's mainstream. That's not necessarily MMT. That's mainstream. So he's contradicting his own mainstream analysis. And he's also contradicting my analysis, which I guess you could call MMT. But that's through any lens. There is no lens that doesn't give you that if you look at it closely.
Right, okay, but now I'm confused, Warren, because is it MMT or not MMT? You said in two sentences that is
It's MMT, but it's not exclusively MMT.
right, okay, so but no, but,
MMT and mainstream.
but a new Keynesian would never say that the government deficits never matter.
I
Right.
wouldn't say that either, but I would say for solvency purposes it never matter.
But that's
So
not
I
what
say-
that he's. I mean,
Well, nobody says deficits never matter, just, by itself, there's always a context.
mhm.
Maybe they matter because you're gonna lose the election. I mean, matter for what? Okay, but that's what he does, that's what the MMT critics do. They
So
have
you
an
say
open
he's
matter
too
for what.
vague. Here, you
Yeah,
should specify.
Deliberately vague,
Mm.
deliberately vague. How about maliciously vague?
Okay,
Yeah, it's a political technique.
all right, okay, so we're,
I mean, I can
we're
do
gonna
that
say
too, but I
myth.
don't.
No,
It's
please don't.
intellectually dishonest. It's an intellectually dishonest statement.
All right, so it's a myth, right? And
Yeah.
okay. I know we can get into sort of all the nuances around it.
Well, that's like, look, are you still a communist? I mean, that's, I don't know what you call those kinds of questions.
Yeah, but I mean, in all honesty, I think you do sometimes make it a bit tricky for people to see through that because you actually engage with it fairly seriously. And first, saying in some way, not completely, but that indeed deficits never matter. I mean, you
Well,
don't exactly say that, but you can understand how people
If
can
I don't
interpret it
qual-
like
if I don't
that, right?
If I don't qualify it, then I should have, or I didn't have time, or I made a mistake or something. But I'm pretty sure I qualify statements like that. I don't make statements like that are unqualified. Because that's what I'm arguing against, all these unqualified statements.
Yeah, you're right. So what I meant is more like, even what you just said, I think people at first can interpret that as, indeed, Paul Krugman says that, and now Warren repeats it. But then you give some nuances, but they're very, very nuanced. Anyway, let's
Well,
stick
this-
with myth.
Yeah.
I have another one for you. Modern monetary theory. This is from a Twitter user called Demetri Kofinas. Modern monetary theorists will tell you that solving inflation is easy. All we need to do is raise taxes. Imagine trying to pass tax increases in this political environment. Crazy. The fact that smart people pretend this makes any sense remains an unsolved mystery. This is MMT or a myth?
It's a myth, it's a straw man argument. It's always Krugman's argument a little bit of a straw man argument. They set something up and say it's MMT and then they criticize it, so it's a myth. I mean, MMT doesn't, no MMT proponent I've ever known says that. It's never said.
I haven't heard, we haven't discussed it in your example, right? You have never said raising taxes reduces inflation.
No, I say raising taxes reduces aggregate demand. So in the case that you've got inflation because of excess aggregate demand, one of your options to reduce demand is to increase taxes. But I also add that I've been watching inflations for a long time now, 73 years ago. And I've yet to, it's possible, but I've yet to see one of them caused by aggregate demand. I just haven't seen it. I'm not saying it's not possible, maybe I've missed, you pointed out, but I just haven't seen it. So that's the rarest kind of inflation that I've seen personally.
And okay, and then this brings me maybe then to sort of a very topical issue, inflation today, which is sky high, at least in where I am here and where you are, the United States. What type of inflation is this? This is not an aggregate demand inflation, is it?
Well, look, the word inflation has become a generalized term that doesn't tell you much, except it becomes synonymous for prices are high. Prices went up and they're high.
Yeah.
It's not that they're going up next year, so right now I've got to pay this much for gasoline, I've got to pay this much for energy to heat my house, I've got to pay this much at the grocery store. So prices are high, and the real question people are asking is, why do prices go up? My incomes haven't gone up, what's going on here? Now, your first clue is that when prices go up without incomes going up proportionately, at least when I grew up, went to school, that wasn't inflation, that was a shift in relative value, a shift in terms of trade. Okay, these were, we had relative value stories versus inflation stories. Inflation is where everything goes up. The United States reprices from dollars to pennies. Everything goes up 100 times. It used to cost $1 now costs 100 pennies. We just had 100 times inflation. Okay, but your wages went up. So we have a situation here where prices have gone up, particularly energy prices. They went up for a couple of reasons. First of all, going back a few years, first big impetus were the tariffs. The president decided that we needed to punish Canada because they weren't charging us enough for lumber. So we put a 17% tariff on lumber. So lumber prices go up. Oh, we've got inflation in lumber. What are we going to do about that? Like, okay, then we just, this is like a politically initiated policy because Canada wasn't charging us enough for lumber. Don't ever send these guys to go shopping. And then President Biden comes in and he decides they're still not charging us enough. So he raises it to 34%. He doubles the tariff. So now we've got lumber prices have gone up some more. And they're not going to come down because we've got these 34% tariffs. And it's like, okay, well, we have to raise rates. We have to do this. It's the Fed's job. Oh, the money supply's up. This was just tariffs. It's pretty simple. We just legislated higher prices. Gasoline taxes. We legislate higher prices. And then, so we had tariffs on 300 different items. And the presidents love these things because they're bringing in dollars. The U.S. needs these dollars. And so there's a profit center for the U.S. to raise prices on the American consumer to bring in money. It's like, oh, that's what it is. It's a tax. But taxes count as, quote, inflation for higher prices. So we had that problem. Then we had the energy issue, which was, and I think the Fed gave that, and then we had the budget.
But this
Plus
is,
the tariffs.
yeah, okay.
And I think the Fed gave out like 0.5% a year of CPI increase. But the big one came through oil prices, right? So oil prices had broken during COVID.
Mhm.
They got down to $40 a barrel, negative on the forward trade. And then they went up to 120. Tripling the price of our basic energy. Natural gas went from $2 something to $9. Right? Everything shot up. Europe is even worse.
Yeah, 600% at some point. That's a pretty insane increases in what I use here for houses. It has a massive impact
Okay.
for
Right,
heating
that's a
costs.
That used to be called a shift in relative value. Now you have to work more to earn the same temperature in your house.
But wouldn't it be called a shift in relative value if other prices went down to compensate for this? And I think this is also something some economists will say. Will say like, but if it was only cost push or from the cost side,
Yeah.
then if we had stable amount of money following monetarism, then prices would go down elsewhere. That's a shift of value to many people, I would say.
Yeah, and that did happen. Okay, you could have had wages go down, I suppose, but to get our cost of production down, it would have been even worse. So that doesn't happen. Our institutional structure is not such that wages are going to get, so it doesn't work in that direction. So other things go up. So you can call it inflation, call it whatever you want, but it's not like a monetary thing. So the answer to it is not to let's cut everybody's wages and then prices will be down. That's the point, right? Yeah, so to get back to the
To where inflation
thing about the energy prices, the other thing about the energy prices is they feed into everything. It's fertilizer we go through, it's it's transportation.
If energy prices now, gas prices going up here, or natural gas, I should say, to avoid confusion
Yeah.
with being a language, natural gas prices going up in Europe means that a lot of cafes or bars will raise the prices for coffee because they cannot pay their bill anymore. Yeah.
Right, and the price goes up, if people don't shop there because they can't afford it, they go out of business. It's not like a market working, and the price of oil is legislated by some, so you're in process, they set the price of oil. There's no others, just like what the government, in terms of exchange, the government sets for its currency, set the information there. At the margin, the Saudis have a monopoly of oil. At the end of the day, we have to buy their 7.5 million barrels a day, or Sheffield Heights of 6.4 ounces. And so they're a price setter, whether anybody recognizes it or not. And they thinly disguise it by setting spreads and setting those prices, but it comes out the same thing. And again, I'm not going to be harsh in criticizing one president or another belief. They're all involved, they're all complicit. But President Trump was on record with the Republicans of having the price of oil frozen, demanding that the Saudis cut production to get the price up because our oil industry was losing money. And Congress has put a resolution through the Republicans to stop stop sending weapons to Saudi Arabia, cut off relations, if they cut production and get the price of oil up so that our oil industry survived. First of all, we didn't need them to do that. Instead of them raising prices on their production and us paying more, we're just giving the oil companies money, it could have been a lot cheaper. I don't want to get into that today, because let's just talk about what actually happened.
Yeah.
And the Saudis were infuriated that our Saudi was stupid, they let us do this. And they got together with the Russians and became OPEC Plus, and each cut $5 million. Got price up, and it's been going up ever since. And now they're buddies, and we're up against them.
So, Warren, so
so
inflation
yeah,
now is the consequence of the government. Government did it, but Russian government, Saudi government, and the U.S. government started with tariffs. Can I summarize the argument like that, or is that?
Yeah. And there was some, there were COVID issues for sure. But those were all transitory, they reversed, I was shipping something back and forth. These other things were the problematic, we had gotten 3 or 4% because of COVID thing where we were careful. We're up at 8 or 9, it's scaring people. Because their theory says that it gets too high, it runs away. It's not gonna just, it doesn't like mean revert or anything, that's what their theory says. It just runs away because they've got all these misconceptions of how it propagates, right? And then we turn it to Venezuela, we turn it to Argentina if we don't get it now. And that's, it's nothing to do with what happened, or we turn Weimar, even worse. It's got nothing to do with what happened. Okay, so we've got that fear, that mythology in our heads. Now you're talking myth.
Yeah. But so I can relate this back, maybe even
Yeah.
to the transitory versus permanent inflation
Yeah.
discussion. I don't know, were you a year ago or something in the camp, oh, this is going to be actually permanent because governments like
Yeah.
Saudi Arabia and Russia are going to push this, or?
Okay, I've been in a camp, and I was there in like 2010 when I went through. Because back in 2008, the cycle didn't break until oil went up like 150. Saudis just started raising the prices and broke it down. Now, there were vulnerabilities in that argument, but that was the catalyst that took it down. And, I was thinking, here they are doing it again. Got up to about 120, and then if it keeps going, then the inflation keeps going. If it stops, goes down, stabilizes, then the inflation's over. It's entirely a function of energy prices. Okay, it was a little bit of a lag. So apparently Biden made some kind of deal with President Biden with the Saudis back in July. He's going to do strategic reserve, but the only way the price came down is they agreed to discount their official selling prices and do the paper to drive prices down into the election. Okay, and then something happened a couple of weeks ago where they had a huge falling out and policy stopped. But anyway, once oil stopped going up and started coming down, you can see the CPI numbers in the U.S. just went sideways. We were heading back towards zero inflation. 0.3 or something. We're back to pre-COVID numbers. And if oil stays here, then I think we're going sideways and we're back. And it's been transitory only in the sense that oil went up, pushed everything up, comes down a little bit, levels off, everything comes down a little bit, levels up. We look at lumber prices, they get up to 1,600, and now they're back to 500. Well, they were 300 or 400 before. They're up a little, but they're not, that's tariffs and everything else. But that big burst is over. All those commodity bursts have been reversed for the most part. And we're back to pre-COVID levels of price stability, except unless oil and gas start going up. And I think they will. I don't know that they will. If they don't, then we won't expect the inflation to come back.
Right, so, but okay. But
Except the higher rates are driving inflation. It won't come
Right.
back to where it was until after we lower the rates. It'll stay. These rates will support inflation at higher levels than they would have been otherwise.
So okay, I like this because now at least we're getting back to sort of.
But is that MMT? MMT isn't that oil prices cost. That's everybody. I hope so. I think that's it.
I think
So-
almost everybody agrees that oil prices have played a big role in inflation in in most countries, like even monopolies, I would guess. Yeah, but okay, that's all right. Because then I think we again get back to even where I'm not fully convinced yet, but I do think it's a very valid argument in the sense that we get back to this interest rate debate, like does it cause inflation or does it does it reduce inflation? Well, that really depends on, is the borrowing effect, less borrowing, stronger than sort of more money through the government paying more interest rates effect?
But will the borrowing effect be overwhelmed by $1 trillion a year of interest deficit spent by the government? It's a big number. Just, you know, I can't say for sure it will, but I just say, look at the data. Everything's going up again.
Yeah.
We bottomed out second quarter and it's going up. Now it's before the rate hikes. Since the rate hikes, everything's going up.
But this gives me an opportunity to move to the last subject that I wanted to discuss with
Sure.
you here, because our economies are also partially quite complex in the sense that we live in an international world. And I know you have made reference to sort of your university example, also living in an open economy, so I'm sure we'll get to that.
Yeah.
But we have, and MMT discussions tend to be held in a very US-centered sort of way, which does issue the reserve currency at the moment globally.
Yeah, but I think that's just empty rhetoric also.
Okay, so that's interesting. So I didn't necessarily say too much about it yet, but perhaps people would say MMT only works in the US because they have the reserve currency. Is that what your sort of is empty rhetoric, or is it broader?
Yeah, that's
Yeah, okay. Yeah.
that's not applicable. You know, that's
So-
not a statement. I don't think.
So that's not the argument I wanted to make, but
Any credence, yeah.
but one thing that I did notice is that you said in one of your papers, or made reference to, like, okay, maybe sort of more mainstream economics can work in a gold standard world, right? But if we have floating currencies,
Well, it depends on how you define
MMT
work.
always applies.
Well, it depends how you define it could work. If you can't sustain full employment, and if you want to optimize your prosperity, your real wealth, you have to have full employment. Because your real wealth is everything you produce domestically, plus your imports minus your exports. As old as economics goes, it's hundreds of years old.
Okay,
There's no refuting that. And so, if you're less than full employment, you're losing your real wealth, so why would you want to pursue that?
Yeah, so if I can translate that, so,
Yeah.
and this is true, right? I think nobody can deny that no current economic systems have sustained full employment. That's never been the case. So unemployment is a norm, sadly.
And you could say the losses from unemployment in 1 year, probably just the United States, just Europe, are larger than the real losses from all the wars in the history of the world put together,
That's interesting, yeah.
given today's productivity.
Yeah, and given that this happens all the time, and wars sort of, and everywhere to the whole population,
Yeah.
and wars only happen
Yeah.
in specified places, and
Yeah.
yeah, okay. I mean, this is definitely some problem that I also, have struggled with, especially when I briefly lived in South Africa, where unemployment rate is sky high, is 25 higher percent, which is
Staggering loss of
yeah, because people are just sitting around, right? They're doing nothing. That's a real shame. That's indeed, and this is, I think, what you refer to as wealth, real wealth, because they don't do anything. They're idle.
and focusing on us, really, and then the loss of humanity and everything else. It's a lose-lose-lose situation.
But one thing that I could imagine, if I were to start a currency now in a new country where I'm dependent on perhaps imports, I might need to charge interest rates because I want to anchor my currency to another currency.
Yeah, see, now,
But that's maybe the gold standard type of world again, where
yeah,
we're
when I
going.
decompose all that, it doesn't make any sense to me. You know, we go through it bit by bit, but that's just,
So I could imagine, like, if I want to start a small island nation next to Europe, for example, I want to start out by anchoring my currency to the euro because that.
why? Why did the UMKC anchor the currency to the dollar?
Sure, I mean, let's make it easier then, right?
In fact, they talked about it, but we said, look, why would you do that? Nobody could come up with a reason to do it.
Because it makes
Once
trade
you see how-
easier to Europe or to US in this case.
I don't think so. I mean, I've said to somebody, I used to give these talks in Italy. What if you go to full employment, Italy can't buy oil? It's like, show me one country in the world ever that can't buy oil. A friend of mine, Marshall Rec, goes sub-Saharan Africa or something.
Sri Lanka cannot buy oil at the moment, right?
Well, if you Google, they had a different kind of problem because they had all the importing organized by the state. But I'll bet right now, if you Google Sri Lanka petrol station, gasoline station, you'll see a station with people filling up their cars with a price in local currency.
Yeah, but they cannot buy enough oil. I think that that's
You
really
can't, you gotta fill your car up and they won't pump shuts off, I mean, I don't think so.
I mean,
think
why
the
are
price
they
might be too
queuing
high.
then?
Price might be too high, are they still queuing? I don't know.
I'm not sure if they still are, but they were for a long time, for sure.
I assume if they were still queuing, I would've seen it. I can really look it up, but if you, and they have specific, they have a fixed exchange rate, just like you said, we are. But, under plenty of countries operating without fixed exchange rates, weak currencies, impoverished countries, there's stations where you can buy it. Now, most people can't afford it, but the oil companies will sell it based on going exchange rates, whatever they are. Okay, and it turned out, I was with a economist named Marcasio or somebody in Rome, telling me, well, in 1973, we couldn't buy oil during the crisis.
Mhm.
And then somebody else told me, no, what happened was, in 1973, the government did not want you to buy oil because they didn't want you to oil. So they were trying to discourage people from doing it. It wasn't that the oil companies were selling it. The government didn't want you to. It was the opposite. They were tripping over themselves trying to find ways to deliver it, and the government said no. So, and if you look at any country in the world, and you look at the global south, you say, what's your macro problem? They say, oh, too many imports, or imports of steel.
Yeah.
Okay, that's the problem is too many imports. Have you ever seen one country where the problem was you can't import? I've just never seen it. I mean, I don't believe it.
Well, I mean, Afghanistan at the moment cannot buy its crucial imports. Lebanon cannot buy enough food imports, right?
So, you know, what does that mean? Because people can't afford it at the going prices and local currency?
Yeah, at the going exchange rate, and that's why the exchange rate is collapsing.
Right. Okay, and so if you look at the total, yeah, but then you say that's what exchange rate, that's the exchange rate is what it is. And it's collapsing for other reasons. And I don't know what their interest rate is, but I was just in Argentina and the problem there was, you know, they were paying 50% interest on their peso debt.
Mhm.
And because their inflation rate was 40, they had to keep a real rate. But the interest goes to people who already have money and they don't want any more pesos, so they just sell it for foreign exchange. So the exchange rate goes down like we're talking. This causes imported prices to go up. So inflation rate goes to 50, so the government pays 60. So now that people are getting 60% pesos, it's like 10% of GDP is peso interest. Selling it, cause the exchange rate to go down, and they're in this spiral. They just went 80% inflation and 90% interest rate. It's like no end to this. Because the interest rate, interest payments are being fed into the foreign exchange markets and pushing down the exchange rate, pushing up imported prices, which pushes up the inflation rate, which pushes up interest rates. It's just this, the horrible cycle they're in, and they keep doing it. Now, maybe the same thing's happening in Lebanon. I don't know. I don't follow every country in the world. But if you look it up, more often than not, there's something like that going on. It's just insidious, and it's at the expense of all these people who can't get enough to eat. It's got nothing to do with operating, you know, with fixed versus floating exchange rate.
Well, I mean, so one thing I wonder about the whole fixed
Yeah.
versus floating exchange rate debate that there is in broader economic circles, because also I think in more mainstream circles there was the idea floating exchange rates solves most of the macroeconomic problems. I think even someone like Milton Friedman was in favor of it.
Yeah.
But there I wonder, how floating are exchange rates actually, in the sense that, sort of, if there are small movements, it's totally fine, and I think it works really well. Also, euro is freely considered to be freely floating. But I think what, for example, you can see in Turkey is that if the moves are too fast, then it does become an issue because imports do get way too expensive. And so, in effect, how floating isn't really. Does that make
Well,
sense?
that's interesting. Yeah, if they are, I mean, you look at Japan, it's down 30 to 40%, right, recently.
Yeah.
Europe dropped by the same amount. The dollar's dropped by that amount before. The Australian dollar went from 105 to 60 or something. Now, all these currencies move a lot. It's not, they don't all abandon them for the gold standard. They all move, and it doesn't have all these horrible effects. In fact, you can't get politicians to agree on whether they want their currency to go up or down. The Chinese currency goes down, everybody starts yelling at them for unfair trade. It's like, right? You went in with too strong into this agreement, too strong an exchange rate, now they trade something. So it's even ambiguous within the political debate whether they want the currency to go up or down. They don't even have that. They don't even have that sorted out.
Yeah, but it might depend on the situation, right?
Okay.
In some cases, you want it to go up. Like now, for example, now there's high inflation everywhere, so you don't want your currency to go down too much. Like if I'm running Europe, I'm not.
What's the inflation? What's the inflation rate in Japan?
Well, I think it has been going up since the yen has come down. Well,
Yeah,
they want it,
2.6.
right? They the money.
Well, that's what I'm saying, you know? That's what I'm saying. It's like, I mean, I have opinions on where it should be, but I'm just talking about the political class doesn't have a clue. If they talk out of both sides of their mouth from one day to the next on this stuff.
Yeah, but you can.
And they contradict themselves in the same sentence.
Yeah, but you can. Okay, fair enough. Like I'm not going to defend the political class, but
That'd be too easy for me.
but I will say, as a European, I liked the exchange rate going down a little bit, especially as someone who operates on YouTube and thus has a dollar income. Okay, I'm like an exporter of services in that way.
Yeah.
So I like that.
Yeah.
But now I don't like too much that the euro is not collapsing, but going down so quickly. Because it adds to a lot of inflation, since Europe imports a lot of stuff that I typically do like to buy from places like Asia, and you do see that, I think, in increased prices and all of that.
Yeah. So it's going down because, of course, the high prices you're paying for prices that are being dictated by
Russia.
Yeah, Saudi Arabia. And, you know, those euros are being spent to people who don't particularly want them. And it's raising the cost of all your production, so your exports aren't as competitive. And, you know, your trade balance just reversed from plus 300
Yes, in Europe,
to
yes.
minus.
We used to be
Yeah.
current account surplus region, long time, now deficit, yes.
Right. So and Japan had the same kind of reversal. All the energy users had reversals. The U.S. has the lowest domestic prices of energy, so our exports are going up, which is helping the dollar. And a lot of what you're looking at is strong dollar versus weak euro too. So you know, when there's things going on in the strong currencies that have been helping them. And we can get a currency discussion for 10 hours or so. Probably not a good idea. But did you have any more myth versus MMT?
I do, yes. Let's. But actually, I think that this would also be a good point to ask
Okay.
some more audience questions, right? I
Okay,
think
good.
I've seen a lot of them come by. So let me see. I did also get a question about Norway. So the question was from a channel called Political Economy, and I believe it was about Norway's foreign wealth fund. So very wealthy through gas exports, right? So the question there was, does that help the Norwegian government's budget? Does it help the Norwegian government to spend more?
What happened was your real terms of trade improved dramatically with the North Sea oil, and so your gives you the benefit of being able to you're exporting oil, so you can import all kinds of other things with the proceeds, and so it's just a big increase in wealth, real wealth for Norway through its real terms of trade. Now, and the exports, of course, were the cost. You could have kept the oil for yourselves, but you sold it, you got dollars and put it in the fund, and now you can use those to buy imports. And that's your deferred compensation, you might say, for the oil you sold in previous years. And I guess you're still selling oil today, right? Are you a net exporter still? I don't know.
Norway.
I mean, you're not Norwegian.
I'm not Norwegian.
But from the point of view of the question.
Yeah, definitely. I mean, Norway is a net gas exporter, so
Net gas
they
exporter.
are running the biggest current account surplus.
Sure.
They're maybe the only country in Europe still running a current account.
So that allows more imports. And, so
All right.
It's a huge
Yeah. I have another question from Buck Franks, who asks, why wasn't inflation coming down on its own during the Volcker era, and they had to enact harsh hikes?
Okay, the inflation came down when the oil price broke. It went from like 40 to 10 or something over a couple of years, but 30-ish and 20, and it started coming down.
Was it after the rate hikes or before it?
That was after the rate hikes, but after the recession that was caused not by the rate hikes. I was there, but I didn't see it covered, but by the fiscal tightening. And the fiscal balance tightened because of the inflation that the rate hikes helped perpetuate. So, for example, we had inflation, it was 12%, and we were running a budget deficit of 6%. Well, in real terms, that means the public debt is dropping by 6%. So that's like running a budget surplus of 6%. and it just got too low to support the credit structure, which was growing because of the inflation. Prices are up. Borrow more for working, and run the business, and just for what we call a general money supply. You know, and the whole thing collapsed because of overly tight fiscal policy, which looked loose on the surface with a 6% deficit, but beneath the surface was a 6% surplus because of the 12% increase in prices. And it caused a horrible cave-in, and nobody quite understood what it was. They blamed the interest rates. The interest rates were actually contributing to the 6% deficit. They were contributing to prices going up, which then caused the real public debt to fall. So in that sense, indirectly, the interest rates caused the public debt to fall because of the inflationary impact. And that's what caused that big crash. And that brought the demand for oil way down in the recession, and that's what turned it around. At the same time, in 1978, Jimmy Carter, President Carter, had deregulated natural gas. And it had all been capped because the price you could charge was only 50 cents, which was $2.50 or something. And once he deregulated it, then they could start producing it again, and the utilities felt comfortable switching from oil to natural gas, and that whole transition started and kind of opened the door to that happening. Kept the demand for oil low over the next 10 years or so, relative to what it had been. As utilities convert, and other places convert, businesses convert to natural gas from oil. So we had that going on. But if you look at what happened to the price of oil, and it went from like $3 to $40, 12 times or something, 13 times in 10 years. So that's like today going from 80 to 1,000.
Yeah,
And-
yeah. I mean,
Okay,
I think
and then-
Europeans can totally understand this now a little bit.
And that's
because
what
like our
happened, right?
nat gas prices did.
But then when it comes down, you'll see the inflation numbers coming down. Back then, they came down very slowly because the high interest rates were keeping them up, was supporting demand, was supporting forward prices, was supporting prices. So the inflation came down, but slowly, and they kept the real rate going down. It took 10 years to get down to 3%, even with oil going from 40 to 10. So that's because the inflationary forces from the monetary policy, the interest rates, were propping things up more than they would have been otherwise. That's the way I saw it.
I think this is very interesting in the sense that I hope also for everybody watching that this gives you a different way to think about this, and this is also something that I don't always agree with it, but I completely see that it's logical. And if I would not agree with it, would only be because I would say, well, I think the borrowing channel is in stronger than the savings channel, or perhaps I would say, well, but I think rates aren't actually that flexible in practice, right? If we talk about the international case, but that's fair, right? That's how economists debate.
I'll agree with you. The borrowing thing can be there in the short term. 2 or 3 months, people get scared of the house. And what the Fed says is that moves things forward, pushes things backwards. So the interest rate changes can move things back or forward in time, is the way they say. And that's true of a lot of individual items. But so far, we've seen GDP accelerate after the hikes. So we'll see what happens.
Yeah,
We've seen
and we haven't seen inflation come down. I think.
We've seen the credit aggregates accelerate. We haven't seen the core inflation come down. We've seen headline come down with oil, but not core. So we'll
Interesting.
see.
Yeah. So one thing, because I also had one question before about sort of trade deficits, and apparently someone told me that you got into a debate with Steve Keen over trade deficits, do they matter or not? And that piqued my interest because I currently would hold the position that I understand why many developing nations want to have a trade surplus. I think it has been demonstrated by Russia and in the other way around by Sri Lanka and Lebanon how handy it can be to have a trade surplus because it gives you a source of foreign currency when other countries get shut down. And the other way around by Sri Lanka and Lebanon, they had too much of a trade deficit in very crucial sectors that they could replace immediately. So I would say it matters. I understand why it matters a lot. Would you agree with that?
Well, if you're going to use it to generate money to buy imports, then it's not a trade surplus.
So no, but they didn't do that.
We're
right?
talking about using it just to build up
Reserve.
financial assets.
Yeah, exactly. As a war chest,
Okay.
which is
you can
very
buy-
useful in a financial
Well-
crisis, or if there's a run in your currency, or if you get in an economic war as we saw with
It's a
Russia.
use, let's do that one at a time.
Yeah.
So for Russia, it wasn't useful, because their dollar deposits were all frozen, so they can't even spend money.
Yes, but how are they keeping the ruble up now? Because they still have that.
Because they don't import anything, they're not allowed to import. So they have no. Yeah, you're not allowed to import, the currency goes up. That's ridiculous. So, but
I'm not sure if I would agree that
they're.
they're not allowed. I mean, I know that we wouldn't
Well,
want
that's what
them to
that's what
import
the
much.
sanctions are, that's what the sanctions are.
Yeah, but they're very leaky, right? They're not really
Sure,
working
but they're not
like
that,
that.
yeah, but they're strong enough to keep the currency.
So but you wouldn't see a role for the capital controls that they put in place there, because I would argue that also
Which
played a
ones
big
are
role.
those? Which ones are those?
So, yeah, Russia. So restricting
they don't
foreigners
allow-
from fleeing, taking their money out of the country,
Taking rubles out?
or dollars. I don't think it matters.
Well, they
too
can't, the
much.
dollars aren't there anyway. They can't, the dollars are credits on Western banks.
Yeah, that's true. Okay, so let's say take rubles out, because then rubles can't be sold on the international market anymore.
Okay, but who is doing that anyway? I mean, they didn't have a problem with rubles leaving the country.
Didn't they?
They had a problem internally with people selling rubles.